Hey everyone, Jack Burdey from the Schaefer financial team here at Canaccord Genuity. I just wanted to record a quick video explaining tax loss harvesting now that we're nearing year end. So what is tax loss harvesting? Well, Investopedia defines it as a strategy investors can use to reduce their capital gains taxes owed. The process involves selling investments that are below your cost value, aka the price you paid for them, in order to intentionally create losses to use against your gains and reduce your taxes owing. Now that may sound a little confusing, so let me explain. To start off, let's take a look at what capital gains are. Well, when you sell an investment that has appreciated in value, the difference between the price you paid for it and the value you sold it for is considered a capital gain. In Canada, 50% of that gain is taxable at your marginal tax rate. So let's use an example. Let's say you bought one share of ABC stock at $100 and you sold it for $120. In this scenario, you would have a capital gain of $20. 50% of that, or $10, would be taxable at your marginal tax rate. So assuming a 50% marginal tax rate, you would owe $5 of tax on this transaction. Now, it's important to note that this does not apply to registered plan accounts such as TFSAs and RRSPs. It only applies to non-registered accounts. Now, looking at capital losses, on the other hand, they work in the exact opposite way. So if you sell an investment that has depreciated in value, the difference between the price you paid and the value you sold it for is considered a capital loss. Again, in Canada, 50% of that capital loss can be used to offset capital gains in the current tax year, or it can be carried forward indefinitely to be used against capital gains in future tax years. So continuing our example from earlier, let's say you bought one share of XYZ stock at $100 and you sold it at $80. In this scenario, you would have a capital loss of $20. 50% of that, or again, $10, can be used to offset capital gains. Now, why is this important? Well, let's say you did have that $20 capital gain from the sale of ABC stock and that $20 capital loss from the sale of XYZ stock. Well, you could use the loss to offset the gain and eliminate that $5 in taxes that you have owing. So taking advantage of tax loss harvesting can be a great strategy to reduce your capital gains, especially in years when you make big changes to your portfolio or you sell investments that you've been holding for a long period of time. Now, it's worth noting that capital losses can be used against capital gains for up to 3 years in the past. So applying a tax loss harvesting strategy can still provide benefits even if you don't have significant gains this year. Last thing to note is because capital losses can be carried forward indefinitely, you're able to create future tax benefits by applying a tax loss harvesting strategy proactively in down years in the market. If you're a client of ours that can benefit significantly from tax loss harvesting, you'll likely be hearing from us before year end. Regardless, we encourage you to reach out if you'd like to learn more or see if the strategy can help keep more money in your pocket. I hope you enjoy the fall, and we'll see you soon.